This is Chris Whalen, CPA, and welcome to the Street Level Business Podcast. My CPA firm specializes in business and individual income taxes. If you find this podcast informative, please take a moment and share it with your networks and contacts. Today's topic is a case study of rental property investability analysis. I get many calls each week where I'm asked to analyze the profitability, cash flow, and tax consequences of real estate investments. I thought it was a good time to present a case study of a basic analysis and to explain my steps and logic in the process. This podcast will be beneficial to anyone interested in real estate investments, but real estate agents will also benefit by understanding these methods. These tools can increase your profitability by selling more investment properties and not just forever homes. Now, there is some homework that needs to be done to assure success in this process. Number one, with regard to a mortgage, how much down payment does your lender need? Have you shopped around to get the lowest percentage down payment needed and best rates? You can get pre-approved for an investment property loan, and I suggest you do. Why is all of this important? Because we need your total mortgage payment to calculate net cash flow and the interest portion of those mortgage payments to calculate the related tax deduction. Remember, mortgage principal is not deductible for tax purposes, only the interest. Without this, we cannot hope to get an accurate analysis. Number two, the fair market value rent. This is where engaging a seasoned real estate professional with plenty of experience is critical. Having these two items in your back pocket ahead of time is vital to this process being successful in the long term. Now, let's take a look at some basic facts here for this case study. So we have a condominium that we're going to buy for $275,000. We see we're going to leave a 20% down payment. That's leaving us a mortgage of $220,000. Real estate taxes are $4,500 per year. The HOA fees are $375 per month. The mortgage payment per month is $1,020. The interest portion is $683. The fair market value rent is $1,900. So now let's go down and take a look at our little spreadsheet here of the cash basis and the tax basis to start analyzing this. So the monthly rent is $1,900. And if you look down below that number, we have 12 months. I set this up so we can have a multiplication in case you want to have an analysis of less than 12 months. For example, let's say you wanted 10 months. You'll notice that the total rent changes to $19,000. So that this is handy to have in case you want to analyze and see what will happen if there's vacancies. So let's just go with the full 12 months as rented. So we have rental income is the same in both. And then we have depreciation. Now, depreciation we can take on the property for tax purposes. It's a non-cash item, but for cash, it's not involved with the cash column, as we can see. So now let me take a little diversion over here to talk about depreciation. All right, so we have depreciation. Now remember, we cannot depreciate 100% of the cost as there is always land involved. I see many tax returns where someone has taken the full cost of a property, divided it by 27.5 years, and then come up with the depreciation. We can't do that. So when you first buy a property, we need to analyze what the total land is and what the total building is, the total building portion. So right now, we always assume 25% is land. So going with our original facts here, we have $275,000 was our cost. I take out 25% as land, and our depreciable basis is $206,250. Remember, the land portion is not depreciable. That leaves us depreciation of $7,500 a year over 27.5 years. Now look below, people have made a mistake sometimes, as I said before, and they've taken the full basis and depreciated it. That would have given them $10,000 of depreciation, which is far too high. So very important that you take a land portion out before you calculate depreciation. So let's go back here. So we have real estate taxes in our list. That's for both cash and tax. Now we have the mortgage payment, as I mentioned earlier. So the mortgage payments total $12,240 for the year. Now that's a cash flow out, but that's not what we can take on the tax return. That's why it doesn't appear in the tax column. Look down one below. the mortgage interest can be taken. So we have $8,200 of mortgage interest that we can take on the tax side. That's very important to differentiate between the total mortgage out on the cash flow side and what the interest portion is for tax deduction. Of course, the interest is the same for both. The condo fees apply to both. So now let's look. We have total cash flow out of $22,040 and only $18,000 on the tax side. So now we can look at what's our net cash flow. We only have a net cash flow of $760, but yet we have taxable income of $4,800. Very, very important distinction here that we actually are going to have taxable income here that's well above what your net cash flow is. So this is very important to review this. Take your time, see how I differentiate what is tax and what is not, what is cash and what is not, or what applies to both things here. So this is a very neat spreadsheet that'll give you an indication of maybe you could do this for yourself and do some investability on your own. Now I want to talk about ROI. ROI is important. So let's say you were break even on this property. You actually had no tax income or loss and no cash income or loss. People think, wow, I'm not making any money. This is a disaster. Well, that's not true because you actually have some really good return on investment. So you originally put down $55,000 down, 20% on 275. Now that means that $220,000 mortgage is going to be paid off over time, but that's going to be paid off by somebody else. So if we look here, the annual decrease in that debt is $7,333. Now someone else is paying that. So technically that's a 13.33% return on investment every year. So this is very important. Your net assets are increasing every year because your net liabilities are going down. So someone else paying off your debt gives a non-cash return on investment, and this is tax-free. Even if your cash flow is a break even, your debt being paid off is well worth the investment. This is quite often missed when people analyze investment properties. Now, I know I went through this a little quick, but I wanted to give you guys a little primer on this process. But of course, I'm here every day to answer any of your questions with regard to investment properties or with regard to anything related to tax or accounting or business. This brings us to the end of this edition of the Street Level Business Podcast. Questions, concerns? Call me on 732-673-0510. Thanks for listening. I hope you found this podcast informative. If you want to become a member of my podcast and memos mailing list, please send an email to chriswhalencpa@gmail.com and I will add you. Remember, the moment you have a business or tax question is the moment you should be calling me. Have a great day.